This is a trade we're in. We're in a broken wing called Butterfly in Tdoc, Tdoc. They have reported earnings earlier, either today or last night, and the stock was down earlier today, just turned green. It's currently up about 3.5% on the day. We're in a 140, 150, 155 call Butterfly with 22 days until expiration. A couple of things we can consider doing here. One, we can take this small win and move on. Or one adjustment I am considering is either rolling the long 140 up 5 points. So this would be sell to close the 140 and buy to open the 145 call. This will make it a balanced call Butterfly with very little risk to the downside. This will also introduce upside risk as well. Another adjustment we can look at, instead of converting this into a balanced Butterfly, we can buy or we can sell the wings, right? So we'll sell to close the 140, sell to close the 155. This will leave me with short 2 of the 150 calls that are in the November 19th expiration cycle. We don't want to hold naked short call options, so we can look to buy to open the 150 calls with more time until expiration. So I'm looking at December 3rd with 36 days to go, buying 2 of those 150s in December 3rd expiration will convert this broken wing call Butterfly into a out of the money call calendar. I prefer, or I like this adjustment more than converting unbroken wing Butterfly into a balanced Butterfly, because as we can see, we have a lot of implied volatility in the front month. In the 19th November expiration, IV is at 45%, while December 3rd with 36 days with more time until expiration, IV is at 43%. So there's still implied volatility higher on the contracts that are closer in time, right? November 19th has 22 days. December 3rd has 36 days. IV on November 19th is higher than the implied volatility in the December 3rd expiration cycle. What this will do, this will cut my net delta from about plus 14 to about plus 6.5 or plus 7. So I'll have less directional exposure, meaning I'll make less dollars, if you will, on the way up, but I also will lose less on the way down. So I'm okay with it. This will also increase theta, which means for every passing day, this position is going to make a little bit more profit being a calendar than it would be as a broken wing or a balanced Butterfly. So the idea here is to reduce directional risk, right? We don't know where the stock is going to move next. So far, we're seeing a pretty decent price action, being that the stock opened lower and now it is trading higher. So to kind of protect ourselves from a drastic move to the downside, being in a call calendar will give us a little less directional risk, a benefit, and we'll also get a lot more theta decay options that are closer to expiration in time, decay at a faster pace. So the November 19 short 150s are decaying much faster than the December 3rd 150 calls. So I really like this adjustment better than the other two. So what I'm going to do is I'm going to sell to close the 140. I'm going to sell to close the 155. And I'm going to sell to close these 2 calls. And I'm going to buy to open the December 3rd 150 call. The 150 calls in the front month and in the back month have to have the same number of contracts. This will make it a call calendar with 22 days to go. Best thing is that Stock is trading somewhere inside of this profit tent, so somewhere inside of 140 and call it 160 over the next couple of weeks. I think we should be able to pull maybe 30, maybe 40% return on risk in this trade.